Welcome to the Twomey Stock Market Report. Today is Sunday, February 12th, Super Bowl Sunday, and we're coming to you from sunny Boise, Idaho. So, what is going on with the market? We've got the new Twomey Stock Market Weekly Report out, and all you have to do is go to the website twomey.com. That's the number 2, mestocks.com. And there you'll see the tab for the weekly newsletter, and you can also sign up for our trade alerts and trade tracker and all our information. But pull down that newsletter and you can get more in-depth analysis of what's happening in the stock market, both fundamentally and technically, over 20 pages of insight that you can digest over the week. So I'm going to start with a couple of things, right? And pardon me as I scroll through here, but the markets are taking a much needed breather. And the question now remains, are we going to continue the advance that we started in year to date, 2023? Are we going to have a pullback, and of how much and what magnitude? So for now, we're still bullish and long. We've flipped over and we're now short Treasury yield. So we're seeing yields start to rebound slightly. And we're going to go into that a little bit of detail. But first, let's go over some technical data and some fundamental information that we track. CBO numbers, that put to call equity. So it registered 0.69, up from last week's 0.57. But more importantly, the last 4 weeks previous ranged anywhere from a low of 0.51 to a high of 0.6. And now we're registering a little bit higher, 0.69. Anything above 7, is a little bit above neutral. And then higher than that, we start to see bearish signals in the market. Right now, anything, below 0.7 or below is fairly benign and bullish. We continue that trend. And that's very interesting because we did have quite a bit of sell-off into some of our technical indicators, which makes traders very nervous. But it doesn't seem like there's a lot of short sellers lurking out there. If we look at our much watched advanced decline line, that's what we'd like to look at for a little bit more from an interpretation, not day to day, but from a overall view of the last several months trending, and certainly the last year. And a couple of things stand out in this advance. This is as of close of Friday. We still are remaining the golden cross, with a 50 EMA is crossed above the 200 EMA, and that's hasn't happened for quite some time. You've seen me talk about that. We've now have the advanced decline, the SPY, the Dow, the small caps, all in this what we call golden cross. That usually indicates more bullish sentiment going forward and gives higher support for stocks on any retreats. 50 EMA, we use the exponential moving average to sort. Whether it's moving average or exponential, bottom line is the 50 indicates where short-term buyers are headed, and short-term buyers are bullish. The 200 EMA is a much bigger picture, obviously, of days, and that tells us that we're not seeing tremendous selling, and people aren't necessarily getting out of the market. So the 50 has a chance to expand above the 200. Very bullish. So that's great. We also had more importantly, the RSI was up over in the 75 last week. Now it's dropped down to a low of 56 and a half, right? So that has abated this oversold indicator. The last time we were up around those numbers with the bear market highs, we were in the low to mid 70s for RSI, and we abruptly started to sell off. We had a back and forth and then hit new lows. Actually, we tested new lows twice, created two lows twice. So the premise is, are we going to hold and go sideways, much like the Dow and the diamonds is our proxy? And we anticipate that what it is, but we're not in the prediction business, so we have to follow that data. If we do have a trend of a sideways move, the markets take a breather and digest the recent run up, especially into the high beta stocks and growth stocks and the NASDAQ and small caps. That's good. That's good. If we don't and we break down below that 50 and then 200, we're going to test the lows of at least December at that stage, and then maybe further. So for now, we're on watch only. RSI for this, if you could see up here, and you can look at closer when you pull down our report. The diamonds are proxy for the Dow Jones. Now it's at 52, and the last, since mid-December, it's really, pretty much stayed at that mid to low 50s, and except for one peak there in mid-January. But overall, everything has abated. The SPY is at 56. The Nasdaq's now 57, and the Russell's 54. So that's telling us that we've alleviated the overbought situation. Will it hold like the Dow has? Very promising. If it doesn't, we return to the December lows. So that's what the RSI is telling. The sector table, we won't cover too much here, but the net of it is we look at what typically for the last 12 months, but the year to date only goes to January 2023. So we look at the 6 month, what's leading the charge: energy, financials, and materials. So of short, the 1 month, which we have sorted this table, it's all information technology, IT, the high-tech sector, and the consumer discretionary, as well as services, communication services. So that's interesting. But we are seeing down the 1 month, all the defensive sectors are in the red: healthcare, consumer staples, utilities. People are getting out of that and moving up into these other categories and snapping up those low priced stocks, or the stocks that were beaten down in 2022. The last 5 days, that's all been reversed, and the only thing that's in green is energy. So we are seeing the market change a little bit. Will it persist? Right now, short term, we've got selling pressure. Long term, we'd like to see that retain. We did switch into bonds. We are now short bonds. We're using a 200% TBT, which is when we're up 3% since we jumped in midweek last week. Yields are starting to rise again. That's a concern, because that's telling us the market predicts 6 months ahead, and they're saying that interest rates are going to remain high. And I think finally, you'll go into my detail on my market report. Finally, the investors have realized that high interest rates, whether it's 5, 4, 6 to 8%, it's going to persist well into 2023. The Fed are going to raise their rates and get into that nominal rate of 5.5, 5.75. We're not going to retreat. We're not going to start seeing, unless some cataclysmic economic collapse, we're not going to pull back on those rates. And that's all. The economy is slowing. The manufacturing index is slowing. It's below 50 3 months in a row. Will the stimulus spending on all these bills carry over and keep people working, or will the high-tech sector leading the way with layoffs continue to permeate, and then we get job losses? Right now, job market is holding this economy up. How long that lasts, that's what we're watching. A couple other things I'd like to look at are the Dow Jones, the daily chart here, you could see a couple of key indicators. It's been going sideways, just narrow trading range. We are below the 9 EMA, and we just closed at or above the 14. So our short-term indicators would say, hey, if you're holding that index, you would probably sell your first third if we break below the 14 EMA, and get ready to sell the second third. We're not near a sell signal, but we're really hovering above a sell signal. If we look at the MACD, it's still positive. That's our longer term trend. It's flattening out. It's still above zero, but it's showing that buyers and sellers are fairly neutral here. Stochastics have dropped down to 57. That's a little interesting, because once we get below 75, and then certainly below 50 short term, that means selling is going to return. When we say stochastics, we're talking 3-5 days kind of thing. MACD, we look at a longer trend. So, the Dow's up 0% for year to date. So it's the lagger, whereas the Nasdaq's 11%. So if the Nasdaq starts selling off in the small caps, we hope that it does mirror what we see in the Dow the last couple of months. And if it does, that's promising to the market as it digests the gains. So if you look at the SPY, this is a busy chart, but the net of it is same scenario. If you're holding that, we would have sold the third last week, and probably another third coming up, and then it's going to bump into either the 50 or the 200. I use exponential moving average. The 200s first, and the moving average is the 50 is first. And I would say if the 50 holds like the Dow Jones back here, scrolling again, how that 50 has been really the benchmark to beat or hold, that's pretty good. With the backdrop, the 200, because they're very close, That's very good. If we break below that 50 moving average, we're going to test the lows of December, most likely. So we've got to watch that. That's what's happening this week. We look at the overall year-to-date, the last 12-month trend, the downtrend, this red line, the Twomey trend track line, and the lower Twomey trend track line. We see that the prices still are above the upper trend line. Very good. They are pulling back. Will that trend line hold? And if you look here, we've got the moving averages. We've got the 50 crossing above the 200, and that's just about that 50 is just about ready to meet where that Twomey upper trend track line. And if those two can be resistance, that's great for the market. That would mean buyers are not selling, short sellers are not aggressively taking positions, and we are looking for that as our next indicator. And we don't have a problem if we go sideways. If we continue and then start moving up again, we're going to have a pretty good first quarter. So we are fairly buoyant. We've tightened all our stops on our very high beta stocks and the high growth stocks, and we've kind of let our other stocks run. We definitely have changed our sentiment. We've jumped out of the pure energy plays, and we're now into more energy plays with high dividends, anywhere from 77.5 to 15%, 11% yields, and that's great because if they go sideways, or if they pull back a little bit, we can still net out anywhere from 5 to 10% for the year. That's if we can hold them, because they will pull down in a tough market on energy. We don't believe that's going to happen from all the economic and fundamental data out there, but we do know it's going to be volatile. So with that said, if we can hold that, that's great. Better than trying to play the ups and downs of the oil market, and certainly natural gas is way down into single digits that we use, UNG. I want to just kind of bring up, the things we talked about, business cycles, right? And that's what the news is permeating, that, hey, is there a recession? It's definitely a slow roll. We haven't had one economic cataclysmic event like the failure of those mortgage companies, or COVID, or savings and loan collapse, or a war. What we're seeing is really a slow eroding of high inflation, which is insidious to all types of people, because 1 week it's carton of eggs, the next week you can't find washing machines, or if you do, you're not going to send your kid to college. I mean, it's really that drastic. I mean, people are just, their belts are tight as they can be. Retirees are going back to work, into menial jobs. They're not getting high paying regular jobs. We've got the high tech sector laying off. That's slowing down. One important thing that I put into the news items are LinkedIn, which is very popular, posting for jobs or searching for companies used to search for jobs. It's very, very popular. They are seeing a 1-to-1 match and they look at all types of jobs, 1-to-1 match for people to open jobs. The Federal Bureau of Labor Statistics say it's 2-to-1, 2 jobs for every 1 person opening. So we're already seeing a contraction of this job growth. So the business cycle, what happens? The economy reaches a saturation point. That's what we call the peak up here. It's the second stage of your business cycle. That's where you have economic indicators do not grow further and are at their highest level, and prices are at their peak. The stage marks a reversal point in the trend of economic growth. There's no growth because it's gone as far as it can, and then pricing gets very difficult. Companies are having a hard time now passing on additional costs. So what do? They're cutting costs by layoffs, or reducing their inventory, or shortening their routes, or getting rid of certain unproductive routes. Subway just said, we're tired of paying these transport costs and the daily movement of slicing. They send out sliced meats to their, franchise. What they're going to do now, in order to save shipping costs and trucking and everything else, they're going to ship the whole, like at the deli, at the supermarket, the whole side of beef, or the turkey breast, or whatever, and they're going to have the people slice it at the stores. We'll see how it works, but they say they added up all the data, and the money savings is astronomical. So that's this is what people are doing. So that's contraction. So that stage, a reversal point in that economic growth. What happens? Consumers tend to restructure their budgets. We're already seeing that. We're seeing a lot of news on that. the peak phase occurs when the economy reaches maximum output, the signaling the end of expansion. After that point, employment numbers in housing start to decline, and they are the leading or contractionary phase. Haven't quite seen the job really, hit that cataclysmic point. It's kind of a slow roll. We've seen manufacturing, as I mentioned, the PMI down below 50. That's a sign of contraction 3 months in a row. Sure, ISM rebounded from below 50 to the mid 50s, but the service sector traditionally, and I was in this industry, so I can kind of tell you the service industry is last to kind of fill or peak, because if people can't find the higher paying jobs, they need money to come in, they're going to jump into that lower service sector, because there's always a need for service, and it's a high turnover, and they peak. And once they peak, then we're going to see some trouble. So the premise here at the Twomey Stock Market Report, we're starting to develop this premise that at this slow roll, inflationary Fed rates are going to stay and remain high. We may be getting more like the 1970s stagflation period, where high inflation and economic stagnation, and inflation drives prices up and reduces the purchasing power. We're not there yet. It'll be a slow roll to get there, and if it does, it'll go for a long period of time, which is very devastating to the consumer, the economist, and companies. And we're also going to, be in that phase before we won't even recognize it, right? It'll kind of creep up on you. So hopefully we don't make that, but we're going to see that. In the meantime, here at the Twomey Stock Market Report, we're staying bullish as best we can. We're going to try to ride out this little bit of a pullback. We're also not going to hang around on our high flyer stocks. Like I mentioned, we're in TBT, which is, up almost 3% since February 8th entry. We're still holding small caps, which dropped down to about 5.5. We've got 8.9% gains on our high tech. That's dropped down a little bit, but we entered that mid-January. Annaly Capital, that's our 15.9% dividend deal. That's minus 1.7. No alarm there. It may pull back a little bit, but hey, if it stays around 0% and we can hold it for 6 months to a year, that's a heck of a dividend, 7 to 15%. So we're trying to feel that if we get into that malaise, these things may give us some capital better than treasuries. I mean, short term money markets, I know Schwab's has dropped from 4.7 to about 4.5. We're starting to see CDs rise. I mean, that's depends. I mean, you're not going to live off of a 4.5% return if you're retired, or if you're trying to get your savings to grow because inflation outstrips it, but it's still not too bad, right? MGM Resource, that sector is just flying. Wind had great numbers. That's up 15.7. Will that hold? We're going to see. XLI is at select sector industry. For industrials, that had been a pretty good one. That's still holding, which is good as the Dow kind of flattens out. The European one, this ETF, we're holding that. Borg Warner, that's that consumer discretionary play. That's up at 14.5. It's starting to pull back a little bit, and we may take some profits on a position on that. We'll alert subscribers with that email. And then, of course, materials, we're still holding on that. That's 1.2%. So you can see we're kind of bouncing a little bit on the lower side of our high flyers. Our pipeline energy, 7%. That's 11.5% yield. We're still holding that. That's been firm. The JP Morgan, another dividend plays 11.5%. That's 0.5. That's a very interesting fund, and we should be able to hold that for a longer period of time. Advanced Micro, we jumped into that, and it's high tech to run. It's kind of abated from, they were up pretty high last week. It's down to 12%. Did let subscribers know if they like. I took a third in profit last week. But we're going to try to hold that as long as we can. And then entered the enterprise products end of January. That's another energy play, 7.5% dividend. That's up 4.2%. 6.22 is Pioneer National Resource Company, which is a great dividend at all. Another dividend play, and that's up 6.2 on our February 7th entry that we alerted subscribers. These are we kind of got out of that XLE and the USO, and of course the UNG's faulted, and all some of the we're going to look at energy as, Devon is another good one, high dividend. We're going to, I'm still holding ExxonMobil. I had subscribers stopped out on that. But with that said, I think, energy is still, going to be here. And if it moderates, we'll get the dividend plays. We're holding our mutual funds, which is a terrific change from last year. And PRBLX is one that you may want to look at. It's more towards the high industrial, not high, more like the Dow Jones and high yielding type stocks in the S&P. I did not give an alert for that, but that's one that you may, if it pulls down onto around 49, you should jump into that. So that's what we're talking about. Here at the Twomey Stock Market Report, we do urge you to go to the website. If I can pull it up here. And here we go. Not Johnny Depp, but the Twomey Stock Market Report. That's the number 2, mestocks.com. There you'll find all this information on the front page, webpage. We post some videos from time to time, the market updates. Or also we're on YouTube with not daily, but market updates, especially when there's news to report on the move on stocks. So what are you going to watch for this week? You want to be, if we see some selling the next early part of next week, which we do expect some back and forth, if our technical indicators can hold, we're going to have, if it starts dipping around the 14 EMA, we're going to unload some, and then we're going to wait to see if that 50 EMA holds like the Dow. And if it does, we're going to be adding and off to the races, hopefully, for a good ending first quarter. If that breaks, and there will be a test of traders out there, because I think there's a lot of weak holders. There's not a lot of short sellers. So, I think a lot of these people are hoping they can hold, but any sign of, downturn, I think we call them weak holders, they'll sell, and they'll sell fast. And, that could be cataclysmic. But probably the first level of defense below that, we'd see the December lows. But who wants to lose money to the December lows? We do not. So here at the Twomey Stock Market Report, sign up for our alerts, and we'll be able to help you navigate those. Enjoy the Super Bowl, and we're coming to you from sunny Boise, Idaho this week. I'm James Twomey. Enjoy your day.